Hey everyone, got an exciting show for you today. I have a private lender from the Fresno Central Valley area, someone that is very well known there. We're going to talk about everything lending, what happened 3, 4 weeks ago, what they're seeing now, and what we might see in the future. So let's welcome Andy Peterson from Zinc Financial to the show. How you doing, Andy?
Doing well, Michael. Thanks for having me.
I appreciate you. This is a very timely topic. As you know, kind of being in the trenches of lending, we went through a shock a few weeks ago, maybe a month ago now. But before we get into all of that, let me give you a chance to introduce yourself and Zinc Financial to my audience, because I believe it's the first time we were lucky enough to get you on.
Yeah, appreciate it. So Zinc Financial, we're a private money lender. We've been in business for about 14 years on fix and flip specific transactions. So we're really kind of a good resource in times like this, as we've been through a couple market crashes, seen a couple ups, seen a couple downs, and have a good knowledge base of where the market has started, kind of what it's transitioned to, and some pretty interesting, you know, I guess evolution of a market of not just fix and flip, but also real estate in general.
Mhm.
So it's a phenomenal industry to be in, and we've been around the block a time or two.
Yeah. Yeah. It's interesting. I just did the math in my head, right? Starting Zinc Financial 14 years ago means you're, I don't know, either right at the peak or the cusp of the crash, or maybe you're late in '06 and you're already seeing kind of the downfall. Um, I didn't ask before I started hitting record, but were you working with Zinc 14 years ago?
No, I was, I think, just in high school about 14 years ago. So,
I never want to assume, but I just
yeah,
had to ask.
my gray hairs will tell you different, but
Yeah.
no, I kind of joined the real estate market in 2015.
Okay,
So
cool.
I'm a relative newbie, I guess,
Good.
in comparison to Zinc.
Very, very cool. Well, let's talk about what just happened, right? So let's see, what day is this? This is the 15th of May, probably late March. We saw a huge shock to the fix and flip business, right? There were
Right.
hedge funds that were basically doing, basically creating their own version of mortgages and selling them off. It was just a continuous pipeline, right? 90% of purchase, 100% of repairs. And then overnight, that business stopped. Um, so I guess first, let's talk about the market in general for fix and flip, because obviously Zinc is positioned uniquely as a private money source. But what were you seeing in the industry back in March, maybe when Fresno went on lockdown, right? I mean, it had to be an interesting time for the business. I mean, what was going on at Zinc then?
Yeah. So, really, there's just been a ton of market activity and a flood of business and capital into the markets, which
Mhm.
made for an incredibly low barrier of entry.
Yeah.
And so we got really competitive really quick. And I think we probably hear it in the restaurant industry more frequently, but like the stress tests just kind of hit, and a lot of those lenders shut the door and just overnight no longer were accepting loans. So it
Mhm.
kind of creates chaos because people are looking for capital because just overnight their deals in escrow, the deals that they just got under contract,
Yeah.
at the closing table, finding out that their deals aren't funding.
Mhm.
So all of a sudden we're getting calls from panicked investors asking, "Are your doors still open?"
Mhm.
And at that point, you're grateful for the opportunity, but also a little anxious of what do people know that we don't
Yeah, exactly.
know. And so we started doing our due diligence and understanding that kind of the capital markets was drying up,
Mhm.
and usually how it was going for us, and I think how other lenders kind of set their business up was we would capital raise, get a fund going, and then give them our credit policy and say, hey, this is what we're underwriting to. Are you comfortable? This is what we'll be doing. This is what our DQ historical default rate is. This is what we anticipate it to be. Here we go. Are you ready? On board? Everyone's on board. But now all of a sudden, people are unsure. 3 million people a week are filing
Mhm.
for unemployment.
Yeah.
People are unsure of what the property is going to be valued at in 3 months,
Mm-hmm.
maybe even 2 months. And so, you're talking about people leveraged at 90% plus 100% of rehab. They're maybe like 120% of the purchase price. So, that scared a lot of people, and they started falling out pretty quick. So, we're lucky enough to have been doing this for so many years, so have a strong capital source. But you see kind of a general delevering of lenders, meaning we're not going to go above 80% of the purchase price. What was typically lending against 65% of an after repair value, or 75% of an after repair value. It's now down to 60 to 65%, because our capital source and our risk profile is based on where the market will be when you can exit. And like, how do you do that in a time of medical uncertainty?
Right. Yeah. It's this is all important stuff for people to understand, because some of the subtle things in the book that I wrote, One Rental at a Time, it talks about the '08 crash and how lending just changed overnight. Right. And it happened again. Right. So I always talk about watch lending, because when lenders get scared, they can say no to the best borrowers. They can, right? They don't have to, it's not a right. They don't have to say yes, right? They can say no, and they can say no for any reason. So it is pretty interesting to watch. So late March, the world kind of shudders, right? Deals are falling apart. I know people that had deals that were supposed to close that the lender pulled it before the wire went out. So you start getting panic calls. I'm sure lots of the people I know in Fresno were calling you going, can you bail me out? Can you bail me out? So you probably went through a couple of weeks. And again, I'm just guessing, tell me if it's wrong, where, the business partners came together and said, okay, where are we? What are we doing? Do we need to lower our risk profile? And it sounds like you have, right? Kind of the outcome is, hey, we're no longer going to do 90% of purchase, 100% of repairs. We're going to do 80. We're going to take our after repair value from 75 to 65. But I think what you're telling me is as we sit here May 15th, the door is still open. Just the rules are slightly different.
Right. And really we're focusing more on what the present value of the property is, not really your exit value.
Okay.
Because that is the strongest proof we have of what the price is and what the price will be upon exit. So, so really that's the best indicator of value in our minds right now. Okay. And, we're taking each deal on a case-by-case basis. Sure. Our principals involved, because, this is an uncertain time. And like, as you mentioned, the '08 bubble, you could probably go through a person's portfolio and see their debt to income ratio or when the balloon payment was due, and then get a good idea of what your default was going to be at a certain time.
Yeah, the '08 crash is very different than today, because the '08 crash or '06 or whatever you want to call that time frame it was so financed with stupid loans, right? These 2 and 28 teaser loans and these variable interest rates, and it was just a bad lending practice that got inflated by Wall Street, and then the asset of choice was single family homes. So very, very bad. Very different today. A lot of fixed rate debt today. So we'll see what's going on. So I just locked up a house on Monday. Or actually, it's a property on Monday. I thought maybe what I do is I throw the numbers at you and see what kind of loan packages, just so we have a real discussion. If you want to give ranges, go ahead. I'm not putting you on the spot to say yes to me. I've already got the financing, but I thought it'd be just fun to have a conversation. Is that cool?
Sure. Let me grab my calculator, because
cool.
I'm more of a talker than a math guy.
Got it. Cool. No problem.
All
right. So I just locked up. It's a 3 properties on one lot. Individually metered, individually gas, water. So they're legit permitted houses. So it's a big, half-acre city lot. I paid $175 for it, or agreed to pay $175,000. Why don't you ask me questions instead of me just spouting numbers? What would you like to know? Let's just, so everybody can play along with this. What would you want to know? Hey, I'll call you up. Hey, Andy, I just got a contract, $175,000, 3 houses. I'm so excited. I want a loan. Your turn.
Yeah. So you're asking a more challenging question than a single family.
All right. Well, let's pretend like it's. Go ahead. Whatever you like.
Yeah. So in this type of scenario, I would find out, are you planning to keep all three properties together, or are you planning to separate them out?
Keep.
Okay.
Keep
So what we would be doing is we would now be valuing that as a triplex.
Oh, okay. All right.
And so I understand it's three single family homes,
Sure.
but how I think us and an appraiser would operate this as
Sure.
you'd be exiting all three properties at once.
Yep.
And you could fit three people in there. So we kind of operate that. So
That's
with multifamily, we're a little more, I guess, conservative, just due to
That's okay.
Who you're exiting to is a different profile than a single family home that you could either go for investment purpose, or you could do
totally get it.
Yeah.
That's awesome, right? That's what people need to realize, right? A triplex, duplex, quad, it may still be residential financing when everybody's out there looking at house hack. But when you're a private money lender, you're like, no, you're limiting the pool of buyers, right? You're now looking predominantly for a landlord. So I totally get it. That's awesome. Okay. So you're going to be a little bit more conservative. Awesome. Totally get it.
Yeah. So the next couple of questions I would ask, and this is just in general, is how many flips have you been on title for in the last 12 months?
23.
Okay. So we would probably give you between 70 and 75% of the purchase price.
Okay.
100% of your rehab.
Okay.
And based on whether you choose the 70 or 75% leverage.
I'm conservative. Let's do 70.
Okay. We would be at 9.75% interest rate.
Okay. All right. So you're talking about $123,000. Okay. Cool. And what was the interest rate?
9.75.
Okay. And that's principal and interest?
That's just interest only to keep your payment down.
Yep. Go ahead.
We're a 6-month term.
There you go.
Only, as I mentioned, with no prepayment penalty. So as soon as you're able to get in and exit, either by refinance or by sale, you're able to pay us off and get on to the next one.
Very, very cool. And then points up front, any of that?
Yeah. So we charge 2 fees.
Okay.
We charge an underwriting fee.
Yep.
Which is a minimum of $3,500.
Okay.
Or 2 points, whichever is greater.
Yep.
And then a doc, underwrite, and appraisal fee.
Yep.
Which can vary between $1,350 if you're not using Zinc to finance your rehab, or $2,250 if you are using Zinc to finance your rehab.
Gotcha. All right. So roughly, again, just rough numbers, about $6,000 in fees, 9.99% interest only, 6-month term. Is there an automatic extension for 6 months?
It's a 3-month extension.
Okay. 3 months. Any cost to that?
Usually a point.
Okay. All right. But it's okay. That's fine. Very cool.
That's another one of the changes that we've had is, since we're a fix and flip lender, our program is kind of based on you being able to get in, rehab, and get out. So we've kind of knocked back the length of our term. We used to be 9 months. We're now 6 months, just due to we're uncertain of where the market could be in 6 months. So we're kind of trying to take on opportunities that are more conservative rehabs with quicker exits.
No, totally get it. I love it. All right. And now, again, this channel gets viewed by lots of folks. Does Zinc Financial only play in California, or only play in the Central Valley, or how many states does Zinc cover?
Yeah, so we're in 10 states.
Okay.
Arizona, California, Colorado, Indiana, Michigan, New Mexico, Ohio, Tennessee, Texas, and Washington.
You did that from memory, or are you staring at a whiteboard?
I did that from memory, but I had to do it in alphabetical order. Otherwise, I get messed up.
Well, that was very impressive. So very cool. 10 states. Some of those all of those are very good states to be in, right? You almost couldn't pick better states. So that's obviously Zinc Financial is a track record of doing this. Did it start in California? Do you know, back in 2006, or where did it start?
Started in California. His native to the area, went to, I believe, Clovis North, and his name's Todd Pickett. is a serial entrepreneur, been in several, started, sold, and exited several businesses, and is a fix and flip rehabber himself, or was,
Cool.
and then started Zinc. So he's very intimately familiar with this area, with this business, and has a great understanding of the construction industry and the construction side. So a really great, valuable asset to have.
Very, very cool. So as we're sitting here, May 15th going forward, obviously Zinc, I'll say Zinc Financial is open for business, right? You've changed the rules to get a yes answer, which is totally cool. I guess before going on to the next question, that's a yes answer, right? You're open for business at these new rules.
We're open for business. I can definitely take your calls. I love going over scenarios. We love to just talk real estate. So
yeah.
we understand these are uncertain times, but our doors are open and we plan to continue.
Very cool. So let's just give your number now before I go to more questions. How would you like them to get a hold of you, Andy?
Yeah, you can give us a call at 559-326-2509. That's 559-326-2509. And ask for either Andy or Chris. We're the two originators here.
Very cool. Andy or Chris. Awesome. All right. So now as we are kind of May 15th, has Zinc, the powers that be, when you have your Monday or Friday meetings or whenever they are, what are you guys talking about for the rest of 2020, right? What are you guys seeing? Are you seeing these forbearance requests? I mean, what do you guys think of the real estate market? Is there any thoughts there?
Yeah, we're confused by it. I guess.
That's awesome.
Yeah, we can argue 6 one way and half a dozen the other.
Yes, exactly.
Because we've done some deals with several investors who purchased the properties in late March and are already exiting with multiple offers on their houses. At the same time, wow, we're talking about a 14.7% unemployment rate nationwide. With a lot of like service and entertainment industry people let go, especially in California. So, what I think what we're really honing in on is we adore properties that are under the median house price in that zip code.
Yep.
With small rehabs, small and quick rehabs. We're finding those have not yet been adversely affected by these current conditions. It's those $700 to $1 million houses. Those are a little more suspect. You got, I think, only Chase and Wells Fargo offering jumbo loans right now.
Oh yeah, it's really tight. Yeah.
Yeah. So being able to exit those is just a whole nother animal.
It's so funny how Zinc Financial and this channel or Zinc, I've been telling people for a long time, below the median, the quicker flips, those are where to play. So instead of just giving a category, why don't we put some numbers on it for Fresno, right? So for Fresno, what does the average loan look like? Is it, because again, you're doing 80% of purchase and 100% of repair. Is the average loan 110 grand, 130 grand? Where, I mean, if you can't say, I get it, but I'm just curious.
Yeah, our average loan is around $173,000, both purchase and rehab combined.
Oh, 173.
In Fresno specific, I would say, 173,000. I would say in this market specifically, we're talking about 140 to 150.
Oh, okay. That makes sense.
I haven't gotten that granular yet.
No, that's fine. Yeah.
Yeah.
So 140, and then again, I guess when you look at your Fresno portfolio, again, just because I know it, it's the only market I can talk about intelligently. Are you seeing a zip code dominated, or is it just kind of all over the map, right? Is it the Tower District 728? Is it the old Lowell District 701, Mayfair 703, or is it all over the board?
I've seen it all over the board, and we've started to get into some like 93720 area codes as well. Wow. We started to see some movement there. Just people are getting kind of creative now. I think one of people we know, Oscar.
Yeah.
He's telling me that everyone was pulling the same like vacant
Yeah.
or
Yeah, everybody's hitting the
vacant
same
property.
list. Yeah. Yeah.
Yeah, so obviously when people start zigging, people start zagging. So we're seeing just a general blanket of the area and not really seeing kind of a specific, hotspot.
Oh, okay. Well, that's good. I mean, Fresno's, what people are really realize about Fresno is it's damn near 1 million people now, right? When you look at Fresno County, right, countywide. So it's the fifth largest city in California and the largest not on the coast. So, and then again, you have all these coastal cities just being unaffordable. Fresno is going to just crush it the next couple of years, I think,
Yeah,
as more
absolutely.
people move there. And then I guess the other question I ask you is, what is the average repair? Um, is the average repair like 30 grand
Yeah,
roughly?
I would put it. I think we're around 23,000 in rehab.
Oh, okay.
Uh,
Yeah, that's quick.
that's not including like demo and permits,
Okay.
but we're trying to steer people away from permits as
Yeah.
current conditions kind of make it more difficult.
Yeah.
And
Timing and all of that. Yeah. You don't want to be adding a master suite today. That would take you 6 months and you wouldn't even have the permit yet.
yeah, exactly.
Yeah. So it's paint, carpet, new granite, new flooring, new kitchen, that kind of stuff.
Yeah, that's the stuff that we're seeing is most popular amongst kind of our more experienced borrower base.
Yeah. So have you already, let's look, if you can, if you don't remember, it's cool, but think about your business in February. So pre-March, pre-shutdown, right? February. And maybe think of April. I'm going to guess your volume was down 40%, either from dollars or transaction. I'm just guessing.
Yeah, right around that right around that spot. I can tell you we were on pace for one of our biggest months in company history when this struck.
Right in March.
So
Yeah.
so kind of the immediate fallout probably put us around like 40%.
Yeah.
40 to 50% of where we were trending.
Yeah, and that's again, running a good business, being unclear about what's coming. That's probably the right answer. I mean, frankly, that's not a red flag. That's a green flag. That's a good thing. You want to get small in uncertain times, right? It allows you to come out of it stronger. So I'm not saying that is a bad thing. I'm saying it is a good thing. So.
Yeah. And, I've been calling it the market re-education because,
in
the last 4 or 5 years, we've experienced unprecedented growth in this market. And as we were speaking a little bit earlier, just a flood of capital into the market, big people getting 90% at 7% interest rates with 1 to half a point.
Yeah.
And just something that's always interested me is the 30-year trend or 30-year treasury bill.
Yeah.
And looking at it 30 years ago, it was at 9.5% for a 30-year note.
Yeah.
And now people are getting 7% for a 6 to 12 month term.
That's crazy.
So, so it's now people are seeing across the board 80% rates in the 10s to 11s, points 2 to 3, and they're like, "What's going on?" Well, that's where it was in 2015. That's where before this happened in 2008, people were paying 13 to 14%. It's I don't know. Is it a regression to the mean, or is this just a blip? That's kind of the half a dozen the other way that we were kind of talking about earlier.
Yeah.
Like, what is this market going to look like when shelter in place is lifted?
Well, I can tell you, having looked at this for 20 years, I'm pretty convinced that, especially with the tweak that they just announced for forbearance, which I think is a good thing for the housing market, I think anything below the median is going to continue to fly off the market, especially if it's in flip condition on the exit. I just think look at the listings in your MLS, right? I happen to look at them every day. The listings below the median, and if you take the median at 250 and you actually look below 200, it's a record low. I've never seen it this low. I think you're going to be really, really safe. I would not touch a flip above I wouldn't touch a flip above 500 grand in
Yeah.
Fresno today, right? That's 2x the median. That is like huge red flag. Don't go. But very awesome, and I'm so glad that we got this done. So again, Zinc Financial, Andy, why don't you give the phone number again? You want him to call and ask for either you or Chris.
Yeah, it's 559-326-2509.
Very cool, man. Anything you want to say, Andy, before we kind of wrap this up? This has been a lot of fun.
Yeah, I really appreciate the time, Michael. Appreciate you being such a great resource for not just this market, but for everyone who watches. So really glad we got the chance to speak, and hopefully we'll continue to speak over the future.
You got it, man. Thank you very much.
All right.